This is OwlUp, where learning happens in minutes, not hours. For a deeper journey, explore all our courses at owlup.co. Now, let's dive in. Welcome back to Chapter 2 of our series, The Curious Case of the Stock Market Roller Coaster. In this episode, titled The Dot-Com Bubble, When Tech Dreams Collapsed, we'll unravel the fascinating and often wild story behind the factors that fueled one of the most infamous market booms and busts in history. So, let's dive in. In the late 90s, you could add .com to a company name, and almost overnight, Wall Street might treat it like the next revolution in business. In coffee shops and boardrooms, people were betting fortunes on websites that sometimes barely had a product or a plan. Analysts began talking less about balance sheets and more about eyeballs, stickiness, and network effects. A startup didn't need profits or even clear revenue to be hailed as a category killer. If you could show rapid user growth, investment bankers lined up to underwrite your IPO, and financial TV hosts treated your stock chart like a rocket launch countdown. Traditional metrics like price to earnings were quietly pushed aside, replaced by slides packed with colorful growth arrows and total addressable market fantasies. The atmosphere blurred the line between innovation and illusion. Sober institutional investors sat alongside day traders quitting their jobs to ride the wave, while regulators struggled to keep pace. In boardrooms, the question subtly shifted from, "Can this business work?" to, "Can we get public before the music stops?" Venture capitalists raised ever larger funds, under pressure to put money to work, so deal sizes ballooned and term sheets went out faster than many founders could write business plans. Lawyers and consultants built entire practices around shepherding these firms to market, collecting fees whether the ideas proved durable or not. Meanwhile, retail investors gained unprecedented access to online trading, turning stock picking into a kind of national pastime. Financial media amplified each success story, and every soaring IPO seemed to confirm that old rules were not just outdated, but an obstacle to progress. By early 2000, the storylines had become strangely detached from the underlying businesses. Many startups went public with filings that quietly admitted, in dense legal language, they had no expectation of profitability in the foreseeable future. Yet on listing day, their share prices could double or triple before lunch. The logic was circular. Prices were high because the internet changes everything, and that mantra seemed true precisely because prices were high. Inside these firms, incentives pushed executives to chase visibility rather than durability. Marketing budgets exploded while operations and logistics lagged. Pets.com famously poured tens of millions into brand building, complete with a Super Bowl ad and a mascot that became a minor celebrity, even as each order shipped at a loss. Others handed out free hardware, free software, or free shipping without a clear path to ever charging full price. As long as fresh equity flowed in, burning cash looked like bold strategy, not fragility. Meanwhile, traditional companies felt forced to respond. Brick-and-mortar retailers launched hurried online divisions. Industrial firms rebranded as e-business platforms to lift their stock multiples. Some bought smaller internet players at inflated valuations simply to show they got it. The line between genuine transformation and cosmetic relabeling grew thinner each quarter. Underneath the surface, though, frictions were building. After the Asian financial crisis and concerns about slowing growth, investors started asking harder questions. How much would it cost to keep acquiring customers? When would margins turn positive? What if competitors could copy the same model with slightly lower prices? Small disappointments, an earnings miss here, a guidance cut there, landed on an increasingly nervous market. In March 2000, sentiment finally flipped. A few high-profile warnings from marquee tech CEOs suggested orders were softening, and suddenly the same stories that once justified stratospheric valuations were reread as red flags. Stocks that were priced for perfection had no cushion for doubt. As prices fell, margin calls forced more selling, venture investors pulled back, and IPO windows slammed shut. Business plans built on constant access to new funding collided with a world where capital was no longer eager or available on those terms. Some failures were almost mundane up close. Webvan didn't just burn cash. It tried to build warehouse and delivery infrastructure in multiple cities at once, assuming scale would arrive on schedule. When orders lagged, fixed costs crushed them. Boo.com spent lavishly on glossy design and complex tech that loaded painfully slowly on dial-up, alienating the very shoppers it hoped to impress. Even survivors got a harsh lesson. Amazon's stock dropped more than 90% from its peak before gradually proving its model. One way to see the period is as a stress test of business fundamentals. Companies that could adapt costs, narrow focus, and show a credible path to unit-level profit often limped through and later thrived. Others, optimized only for fundraising and headlines, had no buffer. Accounting quirks, like booking bartered ad space as revenue, masked fragility until auditors and regulators tightened standards. Boards began demanding clearer metrics, contribution margins, churn, and cohort behavior, not just press buzz or traffic spikes. The hangover quietly rewrote startup playbooks. Beneath the wreckage, the bubble quietly upgraded the economy's operating system. Fiber lines, data centers, and developer talent were overbuilt like a kitchen stocked for a feast that never quite happened, yet those sunk costs later made streaming, cloud tools, and mobile apps cheap to scale. The lesson now isn't avoid hype so much as separate durable rails from passing fads, especially as AI, clean tech, and crypto test how well we've learned to price dreams. The deeper lesson is less about tulip-style madness and more about how stories steer capital. Today's pitch decks still lean on bold narratives, but the best founders pair those with gritty detail, unit costs, bottlenecks, downside cases. As AI and other next big things surge, the real edge is learning to love the footnotes as much as the headlines. Try this experiment. Pick one current hot tech stock or startup, think AI, crypto, or EVs, and using only metrics that didn't really exist in the dot-com era, like actual revenue, cash flow, path to profitability, and customer retention, decide whether you'd invest $1,000 in it today, then write down your yes-no decision and why. Next, pretend it's 1999. Ignore profits and instead justify the same company using only hype metrics, user growth, media buzz, valuation jumps, and total addressable market. Compare your two answers side by side and notice which version of you, 2024 you versus dot-com bubble you, feels more persuasive and why. Over the next week, watch one piece of news about that company each day and see which mindset it reinforces, your disciplined view or your bubble era view. This was OwlUp, your daily step forward. This series continues with more chapters on OwlUp.co. Visit OwlUp.co to access the complete course and continue your learning journey. See you there!